Welcome, dear traders. It's me, Kate Stichina, and you're watching a recap of the Asian session. Asian stock indexes rose on Friday morning. Shares in Japan, China, Australia, and New Zealand recovered following an increase on Wall Street yesterday. However, futures on the US stock indexes slid into the red zone in the morning. What factors caused the drop? What sentiment dominated forex? Let's talk about it in more detail. Recently, markets have been gripped by inflation and recession fears. Depending on incoming data, sometimes market sentiment turns sour because of more signs of an economic downturn. Sometimes traders are spooked by the inflation risks. However, both factors are equally negative for markets. It was confirmed by a Reuters poll of economists on the prospects of the global economy. Overall, 176 top economists took part in it. Their opinions were divided evenly. When asked about the biggest risks for the global economy, 94 analysts noted persistently high inflation, and the remaining 82 pointed to economic woes. Apart from that, investors are also worried about the banking crisis. First Republic Bank is teetering on the brink of a collapse as its shares fell to new all-time lows. As a reminder, shock waves rippled across markets in March after bank turns in the United States and Europe. Traders were extremely anxious about the new collapses, and not much time has passed since then. So, fears over the banking sector have intensified again. According to several sources, the Federal Deposit Insurance Corporation, the Treasury Department, and the Fed are coordinating urgent talks to rescue First Republic Bank. It's not clear yet whether the U.S. authorities will seize First Republic Bank as they did it in the cases of the SVB and Signature Bank. Judging by the intense negotiations with the private investors, this scenario looks unlikely for now. Analysts warn that if the government fails to tackle the issue timely, a domino effect may follow, crushing the U.S. banking system, and the U.S. regulators should avoid it by any means. If this scenario comes true, it will be extremely unfavorable for the US dollar. For instance, at the peak of the banking crisis in March, it depreciated by 2.3% on the last trading day on April, and the Greenback added gains. In the Asian session, it consolidated 101.8 against its main rivals. It climbed amid the prospects of new rate hikes. It started Friday in the bullish price corridor of 101.4 and 101.9. The inflation report released yesterday showed that inflation in the United States is still high. It means that the Fed is likely to raise the key rate at the May meeting, as well as keep it at a high level till the end of the year. Nevertheless, the bearish outlook for the US dollar remains intact. First of all, the greenback is starting to lose its status as the world's main reserve currency. However, it remains dominant in the global trade settlements. Yet it has a strong rival, the yuan, which is slowly but surely gaining momentum. For example, when it comes to bilateral transactions, Brazil, Argentina, and Russia conduct cross-border payments with China in its national currency, ditching the US dollar. What's more, its movements have recently become too predictable. Investors are interested in more volatile currencies, for example, the euro. And the ECB remains committed to monetary tightening. It may even raise its key rate more aggressively at its next meetings. If so, the euro will rise significantly versus the US dollar. As for the yen, it moved in line with the forecast. As widely expected, the Bank of Japan kept its benchmark rate unchanged by an anonymous vote. It also did not adjust the range for 10-year Japanese government bonds. The bank will continue to maintain the stability of financing mainly of firms and financial markets and will not hesitate to take additional easing measures if necessary, Governor Katsuo Ueda said. However, while maintaining a dovish stance, the Bank of Japan said it decided to conduct a broad prospective review of its easing measures. The yen was unaffected by promising of possible changes in the long term after the announcement of the Bank of Japan's rate decision. The dollar-yen pair jumped to 138.5, and the yen continued to incur losses throughout the Asian session, moving in the upward range of 133.4 and 135.9. To some extent, bulls are now hesitant due to the likelihood of a First Republic Bank's collapse and concerns about the default. The Australian currency is declining as the upcoming Fed meeting significantly affects risk appetite. In addition, data published today in Australia showed a slowdown in the producer price index. It was another confirmation that a pause in the tightening cycle by the Reserve Bank of Australia was a wise decision. All of the above factors led to a sharp drop in the Aussie. In the morning, the Aussie dollar pair reached 0.6579, moving in the bearish channel of 0.6579 and 0.6643. The main outlook remains bearish. The New Zealand dollar was also trading very volatile. It was moving mainly in the downward range. At the end of the Asian session, the Kiwi dollar pair fell to 0.6126. However, the Reserve Bank of New Zealand is expected to stick to a hawkish stance. Its meeting will be held next week. Its result may boost the Kiwi against the US dollar. However, expectations of aggressive rate hikes eased following fresh inflation data. Consumer prices declined to 6% in annual terms, and the regulator is sure to take it into account when making monetary policy decisions. So, now the Kiwi is trading near its semi-annual lows, gradually decreasing in the price range of 0.6123 and 0.6161. And that's all for now. Hit the subscribe button and keep close tabs on the market developments. See you soon.